Hi, I'm Yvette Hellier, Partnership Manager at the Auckland Business Chamber, and thank you for joining us today for our webinar around how to successfully close down a business. Although it might not be the normal topic to talk about, we're aware that there are always changes in circumstances where business owners need to close down their business for a variety of reasons. Today we have Angus Ogilvie, the Managing Director of Generate Accounting, to talk through the steps to successfully close down a business. Firstly, welcome, Angus. It's great to have you here today.
Lovely to be here, Yvette, and very happy to talk about a question that a lot of people want answers to.
Definitely. So, Angus, why is it so important for business owners to make sure they close down their business successfully?
Well, the most common entity that most people trade out of is a company. And of course, with a company, you've got a couple of government agencies that are particularly interested in you. One is our friends at Inland Revenue, and the other is the Companies Office. And both organisations are keen to understand where in the life cycle the business is at. So during the course of a business, you will routinely file IR10 and IR4 returns with Inland Revenue as company tax returns. And you'll also pay an annual fee to the Companies Office to ensure that you maintain your registration with them. But when a decision is made to close that business, then there's some tidying up to do, and that's important to address.
So, what are some of the most common situations or events that typically result in businesses having to close?
Well, the most common is a change in circumstance. So um, people may have tried self-employment. They're trading through a company. They get offered a full-time PAYE job and they decide to go and take that up. And so they'll close that company down. There are, let's face it, there are some circumstances where companies fail. And so they cease to trade, is the terminology we use. And then, of course, people retire or they sell the company, etc. So there's all sorts of different circumstances.
So, what would you say people need to think about before even thinking about closing their business?
Right. Well, perhaps it's easier to think about how people do close their businesses. And there's some the textbook method, and then perhaps um, one that's best forgotten about from a textbook perspective. So we'll start with that one. Um, there are some people who just ignore it all. Um, and so they don't file a final return with Inland Revenue. They don't pay their annual fee to the Companies Office. And hey presto, the company falls off the Companies Office. It's referred to as being struck off. And everyone is blissfully ignorant. Um, that way of doing things is a bit like it's probably old-fashioned now, but I'm old enough to remember when we all had alarm clocks on the side of our beds, and the snooze button was something that you'd hit when the alarm came on. It's the same analogy I give to just hoping it all goes away. So you hit the snooze button, and then probably 18 months to 2 years later, you might hear from Inland Revenue to say, we noticed you haven't filed your accounts recently. What's going on? Um, and so then, in order to get affairs in order, the company owner will need to do a set of books. They'll probably need to restore the company onto the Companies Office register to do that. That's an expense, and there could very well be some penalties and interest from IRD in terms of overdue tax because accounts weren't finalised. So that's what not to do.
Hmm.
There are a couple of scenarios in terms of textbook, if you like, and it's important to think about uh, this as a liquidation exercise. So most people think, oh gosh, a liquidation is a bad thing because you're appointing a liquidator, and so your company must be in trouble. And in many instances, the liquidations you read about in the newspapers are precisely that situation where a company has got into financial trouble and they've appointed liquidators to liquidate the assets of the company and close it down. However, there's two types of liquidations. And today we're going to talk about solvent liquidations as opposed to insolvent liquidations. So most people aren't aware that there are two types. And a solvent liquidation is what most people should consider. So this is the, I guess, burying the business, putting it in a coffin, nailing the lid shut, burying it, covering it over, and it's gone. So this is the foolproof way of closing down a business. So you've been trading profitably, you might have sold the business, um, uh, or you may cease to trade, or whatever the reason, and you want to have peace of mind to make sure that the business is dead and buried, if you like. So in order to go through that process, it's really important to inform your accountant when it comes time to do that final set of annual accounts and tax returns, that you are ceasing to trade. So you want to close the company down. This will be the final set of books you do. There's a number of things that you need to consider with that. It's a very long way of getting back to your original question, Yvette. So my apologies. But one of them is GST registration. So if you are GST registered, and most businesses are, then you will, in order to deregister from GST, you'll need to dispose of all the assets in the business. And there's a very good reason for this, because when you acquired those assets, you claimed GST on the purchase of them. When you dispose of the assets, guess what? You need to pay some GST back. So it's typically less, of course, because the value of the asset's gone down over a period of time, but you do need to account for that in your final GST return. So that's step one, is GST registration. And you really can't go any further until you have deregistered from GST. And I'll explain why a bit later. So the next step then is to do a set of books. And all companies must do annual accounts as well as tax returns. And the other thing to think of too, which is important in that exercise, is in the balance sheet, we have an account called the shareholder's current account. And this will appear in all company accounts. And the shareholder's current account takes account of money that has been put into the company over its lifetime and money that has been drawn out by way of income by the shareholder. And I don't often praise the Australians, but they actually have probably a better way of describing it. They call it a shareholder loan account. So it's either money that's been loaned to the company or money the company has loaned to the shareholder. But we call it a current account just to be different. And it can either have a credit balance or a debit balance, just like your bank account. So when you go to the bank, Yvette, hopefully you've got a credit balance so you can take some money out. If you've got a debit balance, that might be a problem unless you've got an overdraft. So it works exactly the same way. So when the account is in credit, it's an asset. It's a liability of the company. And so the company owes the shareholder money. When it's in debit, it's an asset for the company. And guess what? The shareholder owes the company money. And that's an important thing to understand. So you need to do the annual accounts exercise and you will arrive at a situation where either the company owes you money or you owe money to the company. In the latter example, then you will need to record that as drawings from the company and pay tax on the money that you've taken out of the company in your own name as a shareholder. Or alternatively, you might be able to declare a dividend as well. But either way, you're going to have to account for this and let Inland Revenue know. And the reason that's important is that the further you get down the process of closing a company, at some juncture, you will need to write to Inland Revenue, or your accountant will do it for you, and request what's called a no objections letter. A funny sort of a name.
Yeah.
But essentially, you're asking Inland Revenue for a letter that you can then upload to the company's office site when you finally decide to close it. That there's nothing to see here. We're happy that you closed the company, etc. And they will simply not provide a no objections letter if your current account is overdrawn, to use their terminology. So in other words, you owe the company money. So you need to address this as part of your income tax returns so that they've got the information that yes, the account is now back to zero. There's no issue around shareholder current accounts. And then you can once you've filed those tax returns, remember you've deregistered from GST, you've done a final set of annual accounts and income tax returns, they've been filed with IRD. At that point, you can then request that no objections letter from Inland Revenue. Once you get that back, there is a section on the Companies Office website that you can go to, and it's about removing a company. So that's a good thing to remove a company. It's not a good thing to have a company struck off. The struck off method is the snooze button on the alarm. So we want them to be removed. And as part of that exercise, they will ask for that no objections letter from Inland Revenue. And assuming everything's in order, they will then advertise the fact that the company is being removed from the Companies Office register, and they do that in a thing called the New Zealand Gazette, which is probably not a document many people have read, and I don't advise you to either. But it's actually it's now online. They used to publish it in print, but essentially you can go to that and see all the companies that are proposed to be removed. And the reason they do that is to advise any creditors that this company is going to be removed from the Companies Office register. So that's probably a step that we did miss out. Inland Revenue is not so concerned, and Companies Office is not so concerned. But it's a very good idea to pay your creditors as well before you close the company, because we've got this no objection letter from Inland Revenue, but by advertising that on the in the Gazette, that's a red flag to creditors, and they do read this information to say this company is being removed. It's your opportunity to object. So creditors can object to that process and say, look, we're not prepared to remove that objection until we're paid. So that's a process that you can go through. It's not foolproof, however. So I'm going to go back to that solvent liquidation process. So this is what we call a short form removal. So just to recap, we've deregistered from GST, we've done annual accounts, we've done tax returns, we've filed the tax returns with Inland Revenue, we've got the no objection letter, we've uploaded that to the Companies Office website, and normally about 6 to 8 weeks later, the company is removed. That's not the complete burial of a company. So it is possible that creditors could subsequently object, particularly if there's a large sum of money owing. They could go to the High Court and say, oh gosh, we didn't realize this company was being removed despite the fact that it was advertised in the Gazette, and we want it to be restored. And so the High Court can actually order it being restored, and you're back to square one. So the total burial requires the use of a liquidator. And they will work with the accountant. They will address issues in terms of the current account. And it's very important to use the solvent liquidation process if you've sold a company. So typically when companies are sold, you don't actually sell the company itself. You sell the assets, you sell the customers, you might sell some patents that you have, some IP, but you're not actually transferring the shares in the company. And there's a very good reason why people who purchase companies want to set up a brand new company. And that is that if you buy the existing company, you're on the hook for anything that's ever happened in that company's history, which is something you definitely want to avoid. So, it might be, even though you've done a due diligence process to buy a company, the vendor, the person selling the business, might have forgotten to mention that there is a tax debt going back 2 or 3 years that hasn't been paid of 100 grand. And guess what? If you take over the existing company, you as the new shareholder are responsible for paying that tax debt. So you want to avoid that sort of thing. So most people set up a brand new company. The funds for the sale of the company are paid into the old company or the existing company that the vendor has. And of course, human nature. Say you've sold your company for 500 grand, you pull out $500,000, happy days. If you go through the short form removal process that I've outlined, you will have a major tax problem because, of course, that money is paid into your current account. You take the money out. Guess what? Your current account is $500,000 overdrawn. And in order to close the company, Inland Revenue expects you to um, either repay the funds to the company, which almost certainly won't be possible, in order to bring that current account back to zero, or to declare that as income in your own name. So you've gone and sold a company, $500,000, you're up at that top 39% tax bracket. And guess what? You're paying up to 39 cents in the dollar for all that money you've received for selling the company. Not smart. So particularly when you've sold a company and you've got a reasonable return, or any money for it, you should go through what we call a solvent liquidation. So short form is fine. Say if you're just closing down a small company, there's no issues there, your creditors are all happy, by all means go through the short form method. But if you've sold the company, you should seek advice from your accountant in terms of whether you need a solvent liquidation. And the real benefit of a solvent liquidation is it enables you to take those funds for the sale of the business out without being taxed on it. Unfortunately, short form doesn't achieve that. So, rule of thumb, if you have sold a business, always seek advice from an accountant. If the accountant is uncertain, then contact a liquidator and talk to them about solvent liquidations.
Brilliant. Thanks, Angus. It was really good step-by-step process around how to deal with that through, those tax obligations as well as the company registration and some of the other stuff that you talked about. I suppose finally, kind of business closure is often quite a dramatic experience for owners. However, if we do look at the stats, they're not alone. Any
No.
final tips for owners who have had to make that hard call to close?
Well, I always think there's such a thing as a noble failure. So most business owners have given it their all. And if we look back on our lives, we've all made failures of something, um, either because we have done something half-heartedly, or even if we've put our all into it, we've just circumstances have dictated that it wasn't a success. So it's not the end of the world. Um, but some advice I would give to people: it does cost money to close down a company. In the short form exercise, not quite as much. A liquidator will add several $1,000s to the exercise, but as you can see, it's money extremely well spent. For those who go into insolvent liquidation, I think that is the toughest. So you can imagine where there is actually a section of the Companies Act, Section 4 of the Companies Act, which talks about solvency. So it's important that directors of companies trade while they're solvent. And then Section 4 defines what that means. And essentially, in a nutshell, the most important part of that section is that you must be able to meet your bills as they fall due. And of course, most people who go into insolvent liquidation simply cannot do that. So it might be that the sector that you're operating in has, the product or service that you're offering doesn't meet a demand. I mean, in the case of hospitality, where we're still going through a lot of insolvent liquidations, less so in tourism, but you can imagine the impact on those two industries over the COVID
Definitely.
periods. So it's not always the fault of the director. In fact, in many cases, it's not. So um, there should be no guilt or shame associated with going through that exercise. It is actually a legal requirement that if you can't meet your bills as they fall due, that you do appoint a liquidator. It's as simple as that. Just a word to the wise. Having had a couple of clients in the past who have needed to do so, the real shock comes when you sign the piece of paper appointing the liquidator, because at that point, this is your baby. You've taken it from startup through to maybe a established business. It's fallen on hard times, but you've invested blood, sweat, and tears in this business over many, many years. As soon as you sign that piece of paper appointing the liquidator, you no longer have any say in anything. And that comes as a hell of a shock to people. So nothing can really prepare them for that. All of a sudden, the liquidator has control over all the assets in the company, over the bank account. You can't talk to the staff. All sorts of um, problems occur. So it's really good for people to prepare themselves for that eventuality. And perhaps liquidators don't necessarily do such a good job of preparing directors in an insolvency situation. Maybe that's an area they could improve on, because after all, you're emotionally invested in the business too. But no, closing companies happens all the time. And um, so if I was to summarize, if the company hasn't been sold, the creditors are all paid, you really just want to put the company to bed, the short form method is absolutely fine. If, however, you've sold the company, you've received money for selling that company, you do need to go through a solvent liquidation. And if the worst comes to the worst and the company's in a serious bind and you simply cannot pay either your staff or your creditors on time, then you must act. And that's a requirement. There are, sorry to end on a slightly negative note, but if you don't act, there are sections of the Companies Act that you will fall foul of. One is called reckless trading, and you can get into an awful lot of trouble if you continue to trade, but you can't afford to pay your creditors. So, um, yeah, you putting your head in the sand in that situation is not good.
No, thank you so much, Angus, for your time today. I hope our viewers found this informative and provide some information to either help make your decision or understand the steps that you should take when closing down a business. If you are a member of the Auckland Business Chamber, remember you can call our 0800 number for any support, 0800 543 543. Thank you again, Angus, and thanks for your time today.
Absolute pleasure. Thanks, Yvette.